Consider this disturbing experiment. Researchers gave people a choice between receiving $100 today or $110 in a week. Most chose the immediate $100, turning down a guaranteed 10% return in 7 days. That's an annualized return of over 3,000%, yet people rejected it for immediate gratification. Now consider a second choice, $100 in 52 weeks versus $110 in 53 weeks. Most people chose to wait the extra week for the larger amount. Same choice, same 1 week delay, same $10 difference, but completely different decisions based purely on when the choice was framed. This is not a story about stupidity. These were intelligent, educated people making decisions that directly contradicted their own long-term interests. This is a story about psychology, about how our minds are wired in ways that systematically undermine good financial decision-making. And this pattern repeats constantly in finance. We know intellectually what we should do. We understand the principles. We can articulate the right approach, yet we consistently make decisions that contradict everything we know. The gap between financial knowledge and financial behavior is enormous and persistent. Most people understand that they should save more, spend less, invest for the long term, avoid panic selling, and let compounding work. Yet most people fail to do these things. They undersave, they overspend, they trade too frequently, they panic during downturns, they interrupt compounding. Knowledge is not the problem, psychology is the problem. This matters profoundly because finance is perhaps the domain where psychology matters most, and where getting psychology wrong is most costly. In many areas of life, occasional emotional decisions or irrational choices have limited consequences. In finance, emotional decisions and irrational choices compound over decades into the difference between wealth and struggle, between security and anxiety, between freedom and constraint. Charlie Munger built his career on understanding psychology. He studied cognitive biases, read psychology extensively, and applied psychological insights to investment decisions. He understood that markets are driven by human psychology, that bubbles and crashes are psychological phenomena, and that the investor who understands psychology has an enormous edge over those who focus purely on numbers and analysis. Warren Buffett has said that investing is not a game where the person with the highest IQ wins. Once you have ordinary intelligence, what matters is temperament. Temperament is psychology. It's your ability to think independently when the crowd is panicking or euphoric. It's your capacity to delay gratification. It's your discipline to stick with sound principles through periods of doubt. These are psychological capabilities, not intellectual ones. Understanding the psychology behind financial decisions is essential. Your returns over a lifetime will be determined far more by your psychological discipline than by your analytical capabilities. The smartest person who cannot control emotional responses will be outperformed by the moderately intelligent person with strong psychological discipline. This is supported by decades of evidence showing that behavioral factors, not analytical factors, explain most of the variation in investor returns. This video examines the psychological mechanisms that drive financial decisions, both good and bad. We'll explore why our minds systematically make errors in financial contexts, what specific biases undermine good decisions, how emotions override rational analysis, and most importantly, how you can structure your approach to work with your psychology rather than fighting against it. To understand why psychology matters so much in finance, we need to start with a fundamental reality. Humans did not evolve to be good at making financial decisions. Our brains evolved to solve the problems our ancestors faced in small tribal groups over relatively short time frames. We evolved to respond to immediate threats, to prefer certainty over uncertainty, to follow the group, to prioritize the present over the distant future. These tendencies made perfect sense in our evolutionary environment. They're disastrous in modern financial contexts. Consider the mismatch between our evolved psychology and what finance requires. Evolution wired us to respond immediately to threats. See a predator, run now. This served us well for millions of years. But in investing, immediate responses to perceived threats, like market downturns or scary headlines, typically destroy value. The right response is usually to do nothing or to buy more, which feels completely wrong to our threat detection systems. Evolution wired us to prefer immediate rewards over delayed rewards. Food now was more valuable than food later because later might never come. You could die before later. Resources spoiled. This made perfect sense in our ancestral environment. But in finance, preferring immediate consumption over delayed investment means missing out on decades of compounding. The trade-off has fundamentally changed, but our intuitions have not. Evolution wired us to follow the group. If everyone in your tribe was running, you should run too, even if you didn't see the danger yourself. The cost of being wrong independently was death. The cost of being wrong with the group was much lower because everyone faced the same fate. But in investing, following the group means buying at peaks when everyone is optimistic and selling at troughs when everyone is pessimistic. The crowd is systematically wrong at extremes, yet our instinct is to follow them. Evolution wired us to seek patterns and narratives. Our ancestors who saw patterns and created explanatory stories were better at predicting and preparing for events. If certain cloud formations preceded rain, noticing this pattern helped you survive. But in finance, we see patterns in random data and create narratives to explain them, then make decisions based on these illusions. We cannot help but see meaning in noise and create stories to explain randomness. These mismatches between our evolved psychology and what financial success requires are not minor inconveniences. They are fundamental obstacles that everyone faces. You cannot eliminate these tendencies through willpower or education. They're hardwired. What you can do is understand them and design your decision-making processes to account for them. Think about what this means practically. You will feel fear during market downturns. This is not a failure of courage. This is your threat detection system doing exactly what it evolved to do. You will feel the urge to consume rather than save. This is not a failure of discipline. This is your present bias doing what it evolved to do. You will feel pressure to follow what others are doing. This is not weakness. This is your social instincts doing what they evolved to do. The rational response is not to fight these feelings directly. Fighting your own psychology rarely works. The rational response is to accept that these feelings will arise and to design systems that prevent these feelings from driving your decisions. This is the fundamental insight. You cannot change your psychology, but you can change your decision-making processes to account for your psychology. Let's examine specific psychological biases that undermine financial decisions. These are systematic patterns of irrationality that affect everyone, regardless of intelligence or education. Understanding them is the first step toward protecting yourself against them. The first and perhaps most damaging bias is loss aversion. Psychologically, losses hurt about twice as much as equivalent gains feel good. If you lose $100, the pain you experience is roughly equivalent to the pleasure of gaining $200. This asymmetry is hardwired and has profound effects on financial decisions. Loss aversion explains why people hold losing investments too long and sell winning investments too soon. When you have a loss, selling it makes the loss real and painful, so you hold, hoping it will recover. When you have a gain, you're eager to lock it in and feel the pleasure of winning. This pattern, holding losers and selling winners, is exactly backward from what creates wealth, but it's driven by deep psychological forces. Loss aversion also explains why people panic sell during market downturns. When your portfolio drops 30%, the pain is intense and immediate. Your loss aversion system is screaming at you to stop the pain by selling. The rational analysis that markets recover and selling locks in losses cannot compete with the emotional intensity of loss aversion. Most people sell not because they think it's the right decision, but because they cannot tolerate the psychological pain of the unrealized loss. Understanding loss aversion doesn't make it go away, but it helps you recognize when it's influencing your decisions. When you're considering selling an investment that's down, ask yourself, am I selling because the fundamentals have changed, or am I selling to stop psychological pain? When you're considering selling an investment that's up, ask yourself, am I selling because it's fully valued, or am I selling to lock in a gain and feel good? The second major bias is recency bias, the tendency to overweight recent events in our thinking. If markets have been rising for the past year, we expect them to keep rising. If they have been falling, we expect them to keep falling. Recent experience dominates our expectations, even though we know intellectually that past performance doesn't predict future returns. Recency bias explains why people invest the most money at market peaks and the least at market troughs, exactly the opposite of what they should do. After years of rising markets, everyone feels confident and wants to invest more. After a market crash, everyone feels scared and wants to invest less. The best opportunities come after crashes when prices are low, but recency bias makes people least willing to invest precisely when they should be most aggressive. This bias is particularly dangerous because it feels rational. After all, you're just responding to observed facts. Markets have been rising, so investing seems safe. Markets have been falling, so investing seems dangerous. The logic seems sound, but it's based on the false assumption that recent trends will continue, which is exactly wrong at market extremes. Protecting yourself against recency bias requires looking at longer time frames and understanding historical patterns. Yes, markets might have fallen for the past year, but over the past century, they have always recovered and reached new highs. Recent pain is real but temporary. Long-term patterns are what actually matter for your outcomes. The third major bias is confirmation bias, the tendency to seek information that confirms what you already believe, and to ignore or discount information that contradicts your beliefs. Once you own an investment or commit to a strategy, you unconsciously filter information to support that decision. If you own a stock, you'll notice news that makes the company look good and ignore or rationalize news that makes it look bad. If you've committed to a strategy, you'll notice evidence that it works and dismiss evidence that it doesn't. This happens automatically without conscious intent, and it prevents you from updating your beliefs as new information becomes available. Confirmation bias is particularly dangerous in investing because it prevents you from recognizing mistakes until it's too late. If you're only noticing information that supports your thesis and ignoring contrary information, you'll hold positions long after you should have sold them. Combating confirmation bias requires deliberate effort to seek out contrary information and alternative perspectives. Before making an investment, actively look for reasons not to make it. After making an investment, actively seek out bearish arguments. Force yourself to articulate the case against your position as clearly as you can articulate the case for it. The fourth major bias is overconfidence, the tendency to overestimate the accuracy of our knowledge and the quality of our decisions. Most people think they're above average drivers, above average investors, and above average at most things. This is mathematically impossible, but psychologically universal. Overconfidence leads to excessive trading because people think they can identify opportunities that others have missed. It leads to concentrated positions because people are certain their analysis is correct. It leads to using leverage because people are confident they understand the risks. All of these behaviors reduce returns on average, but overconfidence makes them feel rational and justified. The antidote to overconfidence is keeping records and being honest about your track record. If you think you can pick winning stocks, track your picks, and compare them to a simple index. If you think you can time the market, document your timing decisions and evaluate whether they actually helped. Most people never do this because actually measuring their performance would damage their confidence. Now let's examine how emotions specifically override rational decision-making in financial contexts. Emotions and biases are related but distinct. Biases are systematic errors in thinking. Emotions are intense feelings that can overwhelm rational analysis entirely. The two dominant emotions in financial markets are fear and greed, and they operate in predictable cycles. During bull markets, greed dominates. Everyone is making money. Asset prices are rising. Stories of spectacular gains spread widely. The emotional state is euphoria, and the dominant feeling is fear of missing out. Under the influence of greed, people make decisions they know are irrational, buying overvalued assets, taking excessive risk, using leverage, abandoning sound principles for strategies that promise faster gains. Then markets turn, prices fall, portfolios shrink. Fear replaces greed as the dominant emotion. Now the feeling is panic and the desire to protect what's left. Under the influence of fear, people make different decisions they know are irrational, selling at the bottom, moving to cash, abandoning long-term plans, making changes based on short-term pain. The cycle repeats endlessly. Greed at tops leading to buying high. Fear at bottoms leading to selling low. This is the fundamental pattern of emotional investing, and it destroys more wealth than any other single factor. Yet knowing this intellectually doesn't prevent it. When you're in the grip of intense emotion, rational knowledge cannot compete. Consider what happens psychologically during a severe market decline. Your portfolio drops 30 or 40%. Every time you check the balance, it's lower. Financial media is full of alarming stories. Friends and family are worried and discussing their losses. Your stress hormones are elevated. Your sleep is disrupted. Your anxiety is constant. This is not a mild emotional state. This is genuine psychological distress. In this state, rational analysis becomes nearly impossible. Your brain is in threat response mode. The prefrontal cortex, responsible for rational planning and analysis, is suppressed. The amygdala, responsible for fear responses, is hyperactive. You're literally less capable of rational thought in this state. This is why successful investors don't rely on maintaining calm during crises. They know that calm is impossible. Instead, they make decisions in advance when they're rational, and they create systems that execute those decisions regardless of emotional state. They automate contributions so they continue buying during downturns. They write down their investment thesis so they can consult it instead of making emotional decisions. They avoid checking prices when they know fear would be triggered. Think about specific techniques for managing emotions. First, reduce exposure to information that triggers emotional responses. If checking your portfolio daily creates anxiety during downturns, stop checking daily. Check monthly or quarterly. The less frequently you expose yourself to price information, the less opportunity for emotions to be triggered. Second, reframe losses and gains as temporary rather than permanent. A paper loss is not a real loss unless you sell. The portfolio value today is largely irrelevant. What matters is the value in 20 or 30 years when you actually need the money. This reframing reduces emotional intensity because you're not treating temporary fluctuations as permanent outcomes. Third, maintain adequate cash reserves. So you're never forced to sell investments to meet expenses. Being forced to sell during a downturn because you need money converts an emotional challenge into an actual problem. Cash reserves prevent this and create psychological freedom to hold positions through volatility. Fourth, separate your identity from your investment performance. If you view investment gains as proof that you're smart and losses as proof that you're failing, your self-esteem becomes tied to market movements. This makes emotional responses more intense. Separating your self-worth from your portfolio performance reduces emotional intensity. Let's discuss one of the most important psychological concepts for financial success: delayed gratification, the ability to forgo immediate pleasure for larger future reward. This single psychological capability predicts financial outcomes better than almost any other factor, yet it's one of the hardest to maintain. The famous marshmallow experiment illustrates this. Researchers offered young children 1 marshmallow immediately, or 2 marshmallows if they could wait 15 minutes. Some children ate the marshmallow immediately. Others managed to wait. Follow-up studies decades later found that the children who waited had better life outcomes across multiple dimensions, including financial success. In financial contexts, delayed gratification manifests in countless ways: saving rather than spending, investing rather than consuming, holding positions through volatility rather than selling for peace of mind, sticking with boring strategies that work rather than chasing exciting ones, maintaining discipline through periods when other approaches seem to be working better. Each of these requires the psychological capacity to endure discomfort now for benefits later. This is hard. The discomfort is immediate and certain. The benefits are distant and uncertain. Your psychological systems are wired to prefer immediate certainty over delayed uncertainty. The most powerful technique for making delayed gratification automatic is to remove the choice entirely through automation. If your investment contributions are automatically deducted from your paycheck and invested before you see the money, you never have to choose between spending and investing. The choice is made for you by the system you set up when you were rational. Another technique is to make the future concrete and vivid rather than abstract. Most people struggle with delayed gratification because the future feels unreal. 20 years from now is abstract. The retirement you'll need to fund doesn't feel real. Making the future concrete helps. Use retirement calculators to see specific projections. Visualize your future self and what that person will need. The psychological challenge of delayed gratification is that it's cumulative. Each individual instance doesn't feel important. Spending $50 instead of investing it doesn't seem significant. But over years and decades, thousands of small choices between immediate consumption and delayed investment compound into enormous differences in outcomes. Now let's examine the role of social comparison and relative wealth in financial psychology. Humans are intensely social creatures, and we evaluate our circumstances not in absolute terms, but relative to those around us. This has profound implications for financial decision-making and satisfaction. People evaluate their financial situation relative to their peers and reference groups, not in absolute terms. If you earn $100,000 per year, but everyone around you earns $150,000, you feel poor. If you earn $60,000, but everyone around you earns $50,000, you feel wealthy. The objective amount matters less than the relative position. This creates a massive psychological trap. You can increase your income and wealth substantially, but feel no better if everyone around you also increased theirs. You're on a treadmill, running faster, but not getting anywhere relative to others. Social comparison drives many destructive financial behaviors. It drives lifestyle inflation, where people increase spending as income increases to maintain or improve their relative position. It drives status consumption, buying things not for their utility, but to signal wealth or status. It drives investment decisions based on what others are doing rather than on sound principles. Protecting yourself from the destructive effects of social comparison requires several things. First, be very deliberate about your reference group. If you compare yourself to billionaires, you'll always feel poor. If you compare yourself to average global citizens, you'll recognize that you're extraordinarily fortunate. Your reference group dramatically affects your psychology. Second, focus on absolute progress toward your goals rather than relative position. Ask yourself, am I building wealth? Am I becoming more financially secure? Am I making progress toward financial independence? These questions are about you and your trajectory, not about how you compare to others. Third, recognize that what you see of others' financial lives is curated and incomplete. Social media shows houses and vacations, not debt and anxiety. People share wins, not losses. You're comparing your full reality, including your struggles and setbacks, to others' curated highlights. Fourth, develop a conception of enough. If your financial goal is to have more than your peers, you'll never reach it because the target keeps moving. If your financial goal is a specific level of security or freedom, you can reach it and feel satisfied. Let's discuss practical systems for working with your psychology rather than fighting it. The key insight is that willpower is unreliable and depletes under stress. Systems that make good decisions automatic are far more effective than relying on discipline. First, automate everything you can. Automate savings, transfers, automate investment contributions, automate bill payments. Every decision you automate is one less opportunity for your psychology to interfere. The decisions get made by the system you designed when you were rational, not by your emotional state in the moment. Second, create pre-commitment devices. Write down your investment strategy and the specific conditions that would make you change it. When you're tempted to make changes, consult your written strategy. Have you met the conditions for change, or are you just reacting emotionally? Third, add friction to bad decisions and remove friction from good decisions. Make it difficult to access your investment accounts for impulsive trading. Make it easy to increase your savings rate. Structure your environment so the path of least resistance is the right path. Fourth, track and review your decisions periodically. Keep a journal of major financial decisions, including your reasoning at the time. Review it quarterly or annually. This creates accountability and helps you learn from your patterns. If you've engaged with this discussion, you recognize that psychology is not a peripheral concern in finance. It's central. Your psychological capabilities and limitations determine your financial outcomes far more than your knowledge of financial concepts. This channel exists to explore these fundamental psychological aspects of investing and wealth building. If this approach resonates with you, I'd appreciate if you liked this video and subscribed for more content that focuses on timeless principles. Let me close with a synthesis of the psychology behind smart financial decisions. First, recognize that your psychology is both your greatest obstacle and your greatest potential advantage. Your evolutionary wiring is mismatched to what finance requires, creating systematic errors. But if you understand these patterns, you can design systems that account for them. Second, accept that emotions and biases cannot be eliminated. You will feel fear during downturns and greed during booms. You will be subject to loss aversion, recency bias, confirmation bias, and overconfidence. The goal is not to eliminate them, but to prevent them from driving decisions. Third, build systems that make good decisions automatic. Automate savings and contributions. Create rules for when you'll make changes and make those rules strict. Remove opportunities for emotional decisions by limiting price checking and media consumption. Fourth, develop the psychological capacity for delayed gratification. This is perhaps the single most valuable financial skill. Practice it consciously. Make it easier through automation and mental accounting. Fifth, manage social comparison consciously. Choose your reference groups deliberately. Focus on absolute progress toward your goals rather than relative position. Develop a concept of enough that's based on your needs rather than on endless comparison. The investors who succeed over lifetimes are not necessarily the smartest or the most knowledgeable. They're the ones with the psychological discipline to make sound decisions consistently, despite intense pressure to do otherwise. They're the ones who understand their own psychology well enough to protect themselves from their worst tendencies. You can develop this psychological discipline. It's not about being superhuman or emotionless. It's about being honest about your psychological limitations and designing systems that enable good decisions despite those limitations. Smart financial decisions are not primarily about intelligence or analysis. They're about psychology. They're about understanding yourself, your biases, your emotional responses. They're about building systems that enable rationality when rationality is hardest. They're about developing the psychological capabilities that enable good decisions consistently over decades. The choice is yours. You can continue making decisions driven by evolved instincts that are mismatched to modern finance, or you can understand your psychology and work with it rather than against it. The difference compounds over a lifetime into dramatically different outcomes. Thank you for watching. Now go examine your own psychology honestly and build the systems that will enable your success.